Hi, everyone. Today I'm excited. We have Adrian with us from Spartan. He's going to be going through fundraising mechanics, have some Q&A for us, all that. I know you all probably have quite a bit of questions about that since we're like coming in right on the last week or two, so pretty critical spot. That being said, Adrian, I'll hand it over to you to introduce yourself and we can go ahead and jump in.
Sounds awesome. Thanks, Austin. Cool. Hey guys, I'm Adrian from Spartan Labs. We're part of Spartan Group, and Spartan Group is a VC and advisory and a lab based in Asia with offices in Hong Kong and Singapore. We have a portfolio of over 200 companies on the VC side. I head up the product lab where we incubate products and also build ourselves. So we're here as builders as well. And then I've also sat on the other side of the table where I was the founder of a startup and had to fundraise myself. So I think I can speak to multiple angles on fundraising. But yeah, let's get started. So I think we're gonna do like 40 minutes presentation, and then we'll do QA. Want to try to do this more tactical and less theory, giving examples and frameworks. But yeah, I want to start with this quote by Paul Graham. Fundraising is brutal, and one of the most horrible things about fundraising is how distracting it is. So, I think of fundraising as a necessary evil. It's not the fun part of building, but hopefully today we can make it less brutal through preparation and process. And if I were to start fundraising again today, where I would start is probably going back to fundamentals and spending a weekend just going down the YC rabbit hole. Educating and going back to the basics. YC Startup School is free and literally has 20 years of content. Paul Graham's essays are gold, and what I like about it is some of the articles you have to use Wayback Machine to see, so they're oldies but goodies. But generally, understanding investor psychology is half the battle. Pro tip: if you want to set something up so that you can have your own personal fundraising advisor, you could scrape all that content and create a knowledge base of the best ones that you like, and then you can feed that into Claude or ChatGPT to create your own personal fundraising advisor that you can ask questions. But I think as you digest the content, one of the things that you'll realize is that, and by watching other videos and content as well, is that ultimately it comes down to making something that people want. This is a motto and philosophy that YC pushes themselves, but is also something that, if you consider what investors are looking for, ultimately they're looking for products and platforms that are able to do this, even in crypto. So ultimately you want to start here so you can fundraise from a position of strength and not desperation. Looking at the current fundraising landscape is always important because this is very seasonal and cyclical. Where we are now, it's going quite well in terms of capital deployment. So, VCs are deploying, but they're making fewer bets, larger rounds, and higher thresholds. What this means is that there's bigger competition, and the rounds are larger. So don't expect the 2021, 2022 bubble days. There's fierce competition, but the good news is that for core infra, DeepIn, AI, and Web3, um, these are really the sectors that are pulling the rounds right now. And this applies to the projects that you guys are working on with XLR. So looking at what this looks like on a chart, where this was 2021, 2022, we are here right now, where there's capital deployment is coming back, but then the number of rounds, and these are disclosed rounds, are lower. So the rounds are larger and fiercer competition and later stage deals. What this ultimately means is that going back to fundamentals, PMF matters, right? So building first and raising second is still important, even in crypto. Traction beats everything. So ultimately, we want to fundraise from a position of strength, and take it from there. What does product market fit look like for a protocol? So start off by being brutally honest where you are. If you're paying for users, if you're paying for usage, you don't have PMF yet. Focusing on fundamentals, organic growth, is, will send strong signals, and really don't get distracted by governance or tokens until we have real usage. So looking at what a fundraising readiness or fundability checklist looks like, it would look something like this: 7 points. Can you demo something that's working? Do you have at least one user, or one partner and multiple users? Do you have a business model you can explain in one sentence? Do you know at least 3 investors who can invest at your stage? Can you survive 6 months without funding? Does your product work without a token? Are you building for users and not speculators? And looking at this, if your score is less than 4, then you should be building and not raising. If you have 4 to 5 checks, you can start conversations carefully. And if it's 6 to 7 checks, then you're probably ready for the full process. So definitely do a self audit and see if you're ready for fundraising before you start, because it is a brutal process and it is distracting. The right sequence is really to build a great product first, get users, not just speculators or airdrop farmers, or but real users who are paying, raise a small round, achieve PMF, and then raise big with greater leverage because you have traction and you're in a position of strength. Some alternate funding paths that you can explore in between raises or before raises are grants and ecosystem funding, such as this program. There's also accelerators, and then there's these new platforms that some are calling ICO 2.0. So those are players such as Echo and Legion. These are direct community funding, but they're a little different than launchpads because they are more merit-based on the side of the project being able to select their investors. But of course, these are, token sales. So ultimately, based on your stage, you probably want to focus on these areas, but it really all comes down to the stage that you're at. And yeah, to show one platform that we're incubating ourselves, it's a platform that allows you to find these alternate funding platforms very easily, whether they're grants or accelerators. Ultimately, it's a directory, but we also use AI to help you apply for these at scale so that you can focus on building faster instead of raising. So when it comes to the raise, what does that process look like? Firstly, start by doing your homework. So you have to know your investor, and don't waste your time speaking to the wrong investors. The three dimensions that are important when assessing this and making your initial investor list is stage fit. So make sure that their mandate fits the stage of your product, and they invest in appropriate check sizes that match your product stage. Thesis. So this can be both um, category based or um, or philosophy or thesis based. Some some funds have different funds that focus on different thesis. Some are general funds, so you want to know that. Um, you want to understand their how they approach their investments. So read all their posts, understand how they make bets, look at their portfolios, look for adjacent investments. Geography is important, but maybe less important for crypto, but that's also one dimension that you can assess. But ultimately, check size is very important because based on where you are, you want to make sure that you are targeting the right investors and not wasting your time and their time as well. A really good tool to help with this is this venture funding tracker that Decentralized made. So the website is funding.decentralized.co. And you can go here and search across all the investors, see what stages, sectors, round sizes, and locations they invest in. And then you can make your list off of that. In terms of timeline, you should really try to raise and close within a time bound timeline. So treat it like a campaign. What you don't want is to be permanently fundraising or make it an ongoing process. It's got to be have a kickoff and end date. So aim for 8 to 24 weeks. Sometimes this stretches a little bit longer, but ultimately try to get it done fast and close fast. So make sure there's a kickoff with your team. You have your materials prepared. Um, Try to meet multiple investors in parallel, line them up, and then close fast. So don't drag it out because momentum dies after 6 months, and you want to strike when the iron's hot, but also make sure that you are treating it as its own project and a campaign because it is very disruptive to building. The basic fundraising materials that you need are a project blurb. So make sure this is optimized for Telegram, and we'll go over a template for that in a later slide. You want a pitch deck, ideally under 20 slides. You want to have a practice and time verbal pitch. So I think this week you guys are working on that. You want to make sure you know what legal instruments that you're using, whether they are safes or SAFs as well. You want a financial model, so it doesn't have to be too detailed, but something that shows that you understand the business and the drivers of your business. And then all of these go into a data room. You also want to have an outreach list and already be making regular updates to potential investors and potential stakeholders, people that can help. These can be bi-weekly or monthly, but ultimately you already want to be communicating to investors even before you fundraise. So the standard pitch deck structure um, is 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 pretty standardized. So investors like to see this format. They're used to it. Don't try to switch it up. Um, Stick with this. At least make the outline with this, and then you can iterate around it. But essentially, it follows the standard format: problem, solution, product, or how it works, your market, your traction, your business model, your competition, and then your ask. Your team slide also goes somewhere in here. Make sure every slide advances your narrative. Keep it tight. Um, More slides lead to less attention, and focus on the metrics that matter, not vanity metrics, but integration metrics, retention, usage, revenue. Again, going back to where we are, in the current landscape, it is really all about fundamentals at the moment. Some common deck mistakes and what not to do are slides that are too detailed and too verbose. So try to abstract um, abstract things away and simplify. Make sure that the communication points come across. Don't be vague about metrics and numbers, be very specific. So don't give a very generalist um, market size or generalist vision statements like onboarding the next billion users to Web3. Um, and make sure that you have PMF before you even get into token economics. Make sure your team also has um, the relevant domain expertise, and oftentimes um, you know founders forget to mention this, but make sure that you highlight why you've chosen to work on this problem and why your team is the best team to be able to solve this challenge. Um, in terms of how to get in touch with investors, really avoid any type of cold outreach. It doesn't really work. So try to get warm intros. These will lead to much higher conversion rates. Um, you can do this by tapping into your network, advisors, other founders. Um, within XLR, there are also portfolio companies and there are also investors of XLR. So this is also a network that you should be leveraging. And then, yep, conferences, demo days, and events like the one that you guys have coming up. So this is the project blurb template. Um, Generally, it starts with just, you know, 2 or 3 sentences about your project, and then a traction section with bullets, um, some details about how much you're raising, and then links and an ask. Make sure that this is formatted in a way that can be shared on Telegram and then shared from there to Slack or another channel. So basically, it has to be optimized for copy pasta. Um, don't add emojis or crazy formatting that breaks, because ultimately an analyst is going to take that from Telegram, share it in another channel, and they don't want to spend the time reformatting it. So just make it very, very easy for them. Be very specific about your traction, um, and yeah, name drop any recognizable pilots or customers where you can. But this is a very important format because it usually is the um, first warm intro or first way that you get into the door of the VC's hands, and then they look at the deck from here. Generally, the investor meeting will take about 40-45 minutes. Yeah, treat it like a conversation versus a pitch. Um, Make sure that you have it structured though, so that you're aware of time. Push for 40 if the investor asks for 30, because you really need that 40. And make sure you leave time for Q&A as well. And make sure that you're also taking meticulous notes after every meeting. This is very important because as you're going through that fundraising process, you will essentially be getting feedback from each meeting and then iterating through that to refine your pitch and your presentation, and be better suited to answer questions that are asked in those meetings. Some of those questions that you'll face are um, dependent on your category, or dependent on your project, or dependent on your network. But ultimately, try to build an investor FAQ as well, so that when, if you get asked a tough question the first time, then the second time you know how to answer that question. In terms of um, valuation realities. I think this is also an area where you should really understand what the comparables are in your category and in the current landscape, um, before kind of setting this in stone or putting this in your deck. Understand what, what the market is at the moment, um, for valuations. So generally, pre-mainnet, it's 3 to 8 million pre-money, post-mainnet, 8 to 20 million pre-money. But make sure that you this changes a lot. Make sure that you know what it is based on the market for your company at the time, and then optimize that optimize for that. The XLR integration story helps to justify higher valuations because you're building on proven infrastructure. But ultimately, also what you want to do is don't optimize for the highest valuation, optimize for the best investor that can provide strategic value beyond capital. So those could be connections, expertise, future round participation. Process management is really important. So make sure you have this structured as a pipeline, just like you would with a BD pipeline. Set up a Kanban, set up a spreadsheet, track it, um, and make sure that you are meeting 20 to 40 investors in parallel, um, and reviewing your pipeline every week. Like someone needs to update it and move things along. So fundraising is a numbers game, and you have to keep track of your win rate as well. So at each step, your immediate goal is not necessarily to close the deal, but to get to the next step. So tracking and follow-ups are very much key to the process. What a So this is a really interesting diagram of, what a round looks like, and this is written by a company called Fresh Paint, and they wrote a really interesting blog article about raising during COVID, and then they made a diagram about it. It's a bit hard to see, but you can see that um, each of these were different amounts, some from angels, some from institutionals, and each of these connected um, to other investors as well from there. So these are nodes, but ultimately, if you're pitching to like 160 investors, you will have a hit rate and a win rate, and ultimately it is a numbers game. You want to get a very strong top of funnel and move that along to close. But this is a pretty interesting diagram of what it looks like. Once you get past that initial interest, then you'll move into due diligence. So in this phase, investors will check things like your technical architecture. They might do some reference calls, your financial model. They'll do background checks. Make sure that you also have all of this in order when you get to this phase, and also include it in your data room to make it easy for the investor to basically help you close the deal, because at this point they're likely also want to invest in you. So make it easy for them to get all of this information. Getting into some Web3 stuff. So um, when it comes to token strategy, this is where you have to be quite careful. I think also it really depends on your stage as well. But for early stage, um, you usually want to defer the token conversation to later, because ultimately you are still um, at the PMF stage, right? So ultimately you are building for utility, not speculation, and you don't want to be locked in to any decisions about token allocations or token designs or governance just yet. So yeah, try to defer those conversations and be very strategic about how you're handling those. Even if you have a plan or a potential vision to launch a token in the future, I think you want to make sure you have a general idea of how you plan to design the token allocation and the utility of that token, but it doesn't need to be necessarily locked in at this stage, and investors are not going to um, expect that they're locked in at an early stage as well. There are different instruments that you should be aware of for um, um, equity versus token deals, and also how the tokens are mapped to um, the equity raise. But ultimately, the four different types of instruments are a safe for equity, which most seed stage companies use, and then a SAFT for future tokens, and then a token warrant and a TSA. So the SAFT basically means that um, you the tokens will come later, and they'll be delivered when they launch. And the token warrant means that the investor gets the equity now, and they get the option to buy the tokens later. So it's their choice to exercise that. And then the TSA um, is usually for later stage when you already have an existing token or an imminent TGE token sale event. Tokens and equity are important in fundraising because ultimately they map into ownership of your company. For equity, ownership basically looks more like this, where you go through a series of fundraisers, um, where the ownership of the early investors get diluted, and um, uh, but in a crypto startup, typically at some point the ownership gets uh, distributed to the community um, and, through 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 the token generation event. But what's important here is that you can see you don't want to do this too early, because if you did community ownership and operation too early, usually this ends up being a mess and a huge distraction for yourself. So even if you plan to launch a token, think about progressive decentralization. Make sure you have that. Make sure you're building towards it, not chasing after a token generation event. A really good quote that I like is this one: "If the token is the product, then you have no product." Of course, there's some nuance here, but I think for most projects and protocols, this applies. So make sure um, you know, you don't release the token too early, because you're going to attract the wrong type of users, which are people who are there for the token, not actual users of the product. And make sure that you don't mistake the token incentive mechanism for the actual value prop of your product. So the better approach is always build the product first, get great reviews, get real users and customers, and then use the token to reward long-term users and create stickier engagement. What success will look like if you have a successful fundraise is multiple term sheets to choose from, investors adding strategic value beyond capital, um, 18 months runway, 18 to 24 months runway to get to the next milestone, and the team excited to get back to building. So make sure that make sure that there's a close to your raise. And again, treat it like a campaign. You want to get it out of the way, get it done, get back to building. So some key takeaways from this presentation are great products attract great investors. Really focus on the product first, and then focus on building something people want, and you can do it. Don't let fundraising distract you from product development, and the best fundraising position is not needing money. So some resources to share are I'll probably drop this deck after this session, but um, I've made an arena channel where you can get a list of some of the links of the articles and diagrams that were shared here. And then for Superfund, which is our grant directory and accelerator directory, you can use the invite code SuperCorrect to sign up. So yeah, thanks so much for joining the workshop. And I guess Austin, if you're there, I can yeah, hand it back to you and move to the Q&A session.
All right, awesome. I guess jumping in here, we'll just start from the top. We have this question coming in about when you were talking about regular updates. Could you please explain what you mean by regular updates in more detail? For instance, if I reach out to a VC or a GP or a VC firm via email with my pitch deck or data room, should I follow up with updates even if they don't respond to the first email?
Um, so yeah, I think there's two parts to this question. So by regular updates, what I mean is if you meet an investor or someone who could be a financial advisor who can help find investors, or someone you think can be helpful to your project, um, or a potential investor, whether they're an angel or someone who works for a fund, you can ask if they would like to, when you share your elevator pitch with them, you can ask if they would like to um, uh, keep abreast of the developments of your project or stay in touch. And then basically, you want to have a cadence so that every month or usually every month, you're sending them like a short progress update so that they are aware of the progress that you're making. As an early stage startup, you're not that progress update is not always going to be that you had a great week. Some of it could be challenges, but you always want to include an ask in that update, and that is basically like an update that you're sending them so that you're keeping the mind share that your project is making progress until you get to the point where you're ready to fundraise, and then you can put in that ask. But you don't want to out of the blue one day just send the fundraise blurb if you have the regular updates and you're building a relationship. To the second question, if you cold outreach to a VC via email and they don't reply, then yeah, probably not. Then probably you shouldn't follow with updates. But it really depends on how the time frame between the update, I guess. If you're planning on sending them a weekly update and they haven't responded, then I wouldn't suggest that. But if you have a really good update, like you sign a deal, then I think that that might warrant you reaching out to them to share that progress.
Excellent. And then one other one from him. In your opinion, what is the current market condition for funding a pre-seed MVP stage startup?
Is that pre MVP or MVP? Well, I think MVP is yeah, it depends on traction. So um if it's pre-seed's a little different than the diagram that I shared, because that diagram is mainly based on disclosed rounds, and there are also undisclosed rounds that are not included. But if the MVP is completed, I think ultimately it still comes down to fundamentals. So MVP is really the first step of getting traction. And if your MVP is viable, meaning you have paying customers, then you have some traction. But I think if you're that early, then investors might also look at founder market fit versus product market fit. Um, but yeah, if you don't have user traction, then like I would go back to that 7-step checklist and make sure you at least hit 4 or 5 of them before you even think about fundraising. Otherwise, you're distracting yourself from building that traction. So ultimately, build something that users want first, and then you're ready to fundraise.
I think one detail that can be interesting in here, because I see it's something people run into. They'll have, so like in this particular example he gives, where like the MVP is completed and they have their like partnerships lined up, things like that. But maybe they're still on testnet, like so they don't have like their user traction. All of that's kind of lined up. Um, what would you maybe say to a situation like that where like you have this like business development side starting to get kind of fleshed out, but you haven't actually released to users yet?
Yeah, I think you can have casual conversations, and you can put feelers out to investors. So that's different than your raise. Your raise should be a campaign where you have a kickoff and a close, and your whole team is kind of like focused on that, right? But if you're at the stage where you're still building and you're still building that traction, you can still put feelers out. You can still have casual conversations. You can still build that outreach list, and you can still share those regular updates. Because you're setting yourself up for the raise once you have traction. And then you're also getting signals and feedback from those early conversations.
And
So
then
it's like,
going,
I guess you could call it like a lighter kind of raise versus the fundraising campaign.
and then we have one other here. In your experience, what should we set minimum investment size as for a strategic investor? We are having the discussion now compared to our last raise in 22.
There's no rules for that, so it depends on what your last raise was, and it also depends on what your current raise is and um, how much um, how much equity you're willing to sell, essentially, um, and how you want to structure the round. So, if it really depends, like, the diagram that I shared, some of those were angel checks for like 5K, 20K, others were institutionals. So there's no rules around minimum investment size um, for strategic, I guess. I mean, it's hard to answer that without having context on the previous round and how big of a raise you're targeting for this one.
And then we've hit 15,000 wallets on testnet. But in your view, how do we separate signal from noise? What would you track at this stage to know if people are truly engaged versus just trying it out?
So when you're on testnet, normally there are a lot of farmers, and normally you'll get quite high numbers, but that doesn't necessarily mean those are fundamental users that are actually engaging. So yeah, you're right to be concerned that there is probably more noise than signal, and this is just typical of um, testnet metrics. But investors will usually look deeper into just volume metrics like number of wallets. They'll actually look into what those wallets are doing, whether they're actually depositing real money. I think probably if you're building the product, you can also probably see um, in the metrics, whether those are just wallets that people have created or whether those wallets are actually doing stuff, right? So, um, yeah, ultimately you want wallets that are doing stuff and probably find the metric that is less of the vanity metric, the number of, and more of um, the engagement or transactional metric.
Excellent. It seems like a big three line in this is like get on mainnet and make sure you're getting real numbers in there. Make sure you're getting active real users.
Yeah. Yeah, I mean, 15K wallets is pretty awesome, but you know, if like go deeper into the metrics and and make sure that you're fine, you're really optimizing for what matters. Because 15K on testnet is also can be pretty normal when you have a big hyped mainnet launch. You just want to kind of like, yeah, filter out the noise yourself. I think you're probably already feeling that if you're asking the question or
And
sensing
then,
that.
yeah. And then this is a pretty, okay, here. Do you have any recommended tools to go deeper into the metrics?
Um,
It might just be something you personally like using.
I mean, I think the first thing is to figure out what is your metric, right? Like, um, and every project's different. Is it TVL? Is it number of transactions? Is it something else? Yeah, I don't really have any on-chain tools to necessarily recommend for that, but I think the first step is figuring out what is the metric you want to measure, and then I'm sure, yeah, there are a number of tools to get it. Cool.
And then this is a very broad question. So I guess answer it broadly and we'll see what you might think of that. But maybe not the most appropriate question here, but in your opinion, how should we approach users and secure LOIs to show VCs and accelerators? We are targeting institutions, market makers, and solver intent networks. So that's a pretty like open-ended question there, but
Um, well, yeah, I mean, I think if you don't have paying customers, then you can go higher up the funnel to um, leads in the pipeline, um, and then to like warm leads and closed leads and LOIs to paying customers, so you can go higher up, um, which is still traction, and you're still making progress. So LOIs are not as good as closed deals and revenues, but they're still something. Um, I think they're less important these days because it is quite easy to get LOIs, but um, yeah, the way I would do that is like have an LOI agreement or a MOA agreement and um and have a pipeline as well. So make sure that you're like trying to get to the closed deal and the revenue, but if you can't and if you the accelerator deadline's coming up, then yeah, try to get that MOA or LOI. Make sure you just have that template for that.
perfect. And then we're getting close to the end here, but we'll do a last couple here. What are red flags that made you say no to a deal that seemed like a must invest?
Um, some red flags are ones are when you dig deeper into a project, the metrics don't make sense, um, or that the business model doesn't make sense, or that the space is very competitive, and the founder and team doesn't have a strong understanding of of basically the landscape um, around them because they're so focused on building that product and the feature that they don't have a sense of, you know, what other projects are building in the same space, how they're different, and and when the metrics look great on the surface, but when you go deeper into the due diligence process, they kind of break down. So um, there are always reasons for um, different things, but make sure that like you are addressing it and make sure that you also are not so myopically like focus on the product, but also kind of step out to understand um, the landscape and category that you're operating in versus just the idea of the product. Hopefully that's helpful.
Okay, perfect. And with that, unless we get another one slipping in here, we'll probably wrap it up about right now. Thank you so much, Adrian, for going over all of this, preparing those diagrams and everything. Then it's especially the one actually like tracking where all the checks came from. I feel like you don't often see how convoluted and like messy the web of that can actually be. So that
Yeah,
was a
that
great
was
thing to
that's
show
a great
everybody.
article too that I recommend reading and really like going back and yeah, reading some of the old articles because like we often get caught up in the Web3 hype, the crypto hype, and the token hype, but ultimately what we're building are startups. So you know, fundamentally, and some of the old ones from like 10 years ago are still sage advice to this day.
Excellent. Yeah, that's a really good thing to point out because I feel like people seem to be afraid to maybe sometimes take some of that old stuff, feeling that the industry is different now, all of that. But fundamentals have always kind of been fundamentals. So yeah, thank you so
Yeah,
much. We'll probably wrap it up here, everyone. Of course, like we're closing in towards the end, so make sure you get your calls set up, especially now. I would recommend setting those calls up with Ellis. He's taking a lot of the final pitch calls. So if you can't find that link, send him a DM and get something set up. But looking forward to seeing how everything turns out for everybody. That being said, we'll see you all. Bye.
cool. Thanks so much, Austin. Thanks, everyone. Good luck.
All right. See ya.